how we can make use of Elliott waves and the price action to take day trades. So this video is mainly going to be focusing on the day trades. And in this strategy, we want to take a trade during the trading day at a specific time of the day and then every day of the week. So the first thing that we need to understand is the price action. Now, the Elliott wave theory is only good in predicting for us the overall direction or the overall movement of the market on a larger scale. We know from the Elliott wave, we can identify motive waves and then we also have phases when the market is in a corrective mode, right? So after every motive wave, we should expect a correction. Now, I'm not going to get into detail about the motive waves, but we know that generally all motive waves are made up of 5 separate waves, and they are numbered 1, 2, 3, 4, 5. Then we can have our corrective waves, which are always in threes, and they are always numbered using letters A, B, C, or W, X, Y, depending on the type of corrective wave that we are looking at. Now, this alone is not enough to give us accurate entries into the market. It is not enough to give us entries and make profitable trades, but it can help us to identify major turning points within the market, and then we can be able to know the overall sentiment of the market for the particular session that we are trading. I find price action much more accurate in taking our daily trades. Okay, so I focus mainly on gold against the US dollar. This is the symbol that I've been trading for the longest time. And I don't look at any other pairs. I'm just going to be focusing on gold. I've seen that it helps to just pick. I know there is over 100 of commodities, currency pairs that you can trade on the Forex market, but it would really help, especially for beginner traders, if you would commit yourself just to one trade that you monitor day in, day out, every day of the week, every week of the month, and every month of the year. In that sense, you get to feel the cycles as they unfold. You become part of the action, right? So when we are looking at the price action, it would help to look at it at a weekly scale. But I'm going to get into that on the last part of the video, where we actually look at how to take practical trades within the day. Right. So first off, I would like us to get the overall sense or the overall sentiment within the gold market. So we'll look first, we'll analyze the charts using the Elliott wave theory. I have with me here the weekly chart on gold. And as we can see, we've had a clear motive wave from these lows around here to these highs around here. And then we've had what appears to be a zigzag correction. So if I may call this my wave 1 and then this my wave 2, whatever we are having here would be a part of the wave 3. Now, the wave 3 itself looks to have made a wave 1, wave 2, wave 3, and wave 4 has completed around these levels here. Now, we are looking for the final thrust in our wave 3, which is going to be our wave 5 before when we have our wave 5, then we can expect a much larger correction to give us the higher degree wave 4. Remember, this is our higher degree wave 1 or the super cycle wave 1. This is our wave 2. We expect a wave 3, which is going to terminate somewhere around these levels. Then we can have a wave 4 and then a wave 5 on the super cycle. Right. I'm just going to label that. I'm focusing mainly on this last swing here. This is past price action. This is just history, and it is not going to help us much in taking a trade this week or this month. But from here right up to there, this is the current swing that the market appears to be in. And it appears to be a very bullish market on gold, which makes a lot of sense. With the dollar weakening, we would expect that people will turn to commodities like gold and silver to secure their investments. Okay, so in this last swing, we've had a wave 1 and a wave 2, which appears to have been a flat. Then we have a wave 3, which is also an expanding flat, and a wave 4. Now we are waiting for the market to give us a wave 5. So this is our wave 1, wave 2, wave 3, wave 4. We're expecting a further push to the upside to give us a wave 5. So overall, when the market is going to come down, and it will, close to these levels, and then it fails to break, that would be an opportunity for a more long-termish trade to the upside. If the market were to give us any correction at this point, a nice corrective structure, then we'll be looking to buy this in a medium to long-term sense. Okay. Here, I've actually zoomed into the wave 4, which is this wave 4 that we were talking about over here. So I've zoomed into this structure so that we can clearly see if it really does qualify as a wave 4, or if the market is telling us that our wave 4 has been complete. Now, if we look here, we can see that this structure appears to be just a regular flat with waves 1, wave 2, no, sorry, that would be wave A or a W, depending. But if we look at this last swing, appears to be very impulsive, and this could also be a leading diagonal, a 5-wave move. So I would like to call this an A, B, C corrective structure, giving us on the higher degree our wave 4. This is our wave 3 on the larger degree. And then our wave 4 completed somewhere around these levels. And if we can see this swing here, this is very, very impulsive to the upside. So this is going to be our wave 5. That is still on the weekly range. So the overall sentiment of the market is bullish, but does that mean that we just jump in and place our buys? That will be the quickest way to lose our trading capital. Okay, so in as much as the market might be going up, we are not just going to jump in and place our buys, because remember, our trading is going to be leveraged, and as such, it's possible that a small move in the market can wipe out our whole trading capital. So we want to be careful as to when we execute our trades. We actually want to get into the weekly cycle and be able to determine at which point exactly would be most suitable to get our buys. Sometimes, even in a bullish market, you can find a nice corrective structure to the downside. This is normally the strategy that most reversal traders employ. And I found this to be very, very profitable, as long as you understand the cycles and how the market is moving. Okay, so over here, I've reduced it down to the 1 hourly, and it just appears that the market is just doing some random moves up and down, up and down, up and down, up and down, and it can be very difficult to determine which Elliott wave corrective structure this is. But if I'm to look here, one could say this whole thing maybe is a running flat, right? So we have a W here because this is only 3 waves, right? And if we look over here, we also have an X that is in the form of a WXY. So this is also a wave X, right? And then what we are having in this leg should be the final leg or the wave Y. Now we can see that we've already had one swing. This appears to be a correction. We expect another strong move to the downside to give us a wave Y on the intermediate degree, right? Our wave X, we can see that it has subdivided. This is a 5-wave move, a 3-wave move, and a 3-wave move. So because our first leg is a 5-wave move, we're going to call this correction an A, B, C corrective structure to give us an X. So wave W has completed, wave X has completed above the beginning of wave W. So this could either be on the Elliott corrective structures, this could either be a running flat, which is mostly unlikely, right? Or it could be an expanded flat. Now I choose to take my primary view as the latter. I would really expect this to be an expanded flat, just looking at how strong this move to the downside seems to appear. Okay, so long term, short term to medium term, I'm expecting trades to the downside, even though we've clearly determined that the price, the market sentiment is overall bullish, but I would expect this to continue coming down, break these lows, and reverse somewhere around these levels at the 2.618 level or the 3.618 Fibonacci extension levels. Okay, now that we've got the overall sentiment and how the market has been moving over the previous recent trading session, now we actually want to get into how the price has been behaving this whole week and how we can take advantage of that and position ourselves for profitable trades. Okay. So I have here with me the live chart on gold. I'm gonna go to the 1 hourly. And I've included here the session breaks so that we can clearly see how the market has been moving since Monday. So this is how the market traded on Monday, and this was Tuesday, this is Wednesday, this is Thursday, today is Friday. And the markets haven't closed yet, but we can see already there's been a strong move to the downside. Now, how do we use market price to take advantage of this? I've learned over the past few days that I've been trading, past few weeks, past few years, that always when the market opens on a Monday, before the end of that trading day, the market is either going to give you the overall weekly high for that particular week or the overall weekly low for that particular week. And then on the Tuesday, if the market gave you a high on a Monday, you would expect on a Tuesday to get the weekly low. If on a Monday you got the weekly low, you would expect on a Tuesday to get a weekly high. Now, this is not always the case. It doesn't happen every week, but it happens 9 weeks out of 10. On Monday and Tuesday, the market is going to give you the weekly extreme price levels. And then Wednesday, Thursday, Friday is just going to be playing in around that range. Okay. Then on a Thursday and a Friday, there's chances of breakout trades where the market will actually break out of that range if it is expanding the range, or maybe it can just retest fake breakouts. It's just retest and then comes back into the range. Now, this is due to the algorithms that make the prices, the market will try to pump the prices and then dump the prices. People make money, people lose money. Others are laughing and others are crying, right? So let's just quickly get into this week. For Monday, I saw that price went up and then it came down, right? So I'll take this low, seeing that it actually pushed up and went to this high on a Tuesday. So we would say for this particular Monday, The price of gold gave us a weekly low. Don't mind these trade levels for this trade that I'm already in, but I'm going to mark this with a horizontal ray to show me that this is the weekly low that I'm looking at. And then on a Tuesday, the market gave us a weekly high over here. I'm going to mark that range. And as you can see, Wednesday was within the range. We had a fake breakout where the market break below the Monday low, and then it quickly bounced back, came to retest the weekly high, didn't touch it, didn't break it on Thursday. And then today, Friday, we can see that the market is reversing. So I'm of the bias to the short side, where I expect these price levels to probably just give me a nice correction here, a chance to enter and get a trade to the downside. Okay, so I'm here on the Friday. Today's Friday, and I want to take advantage of a market and make a trade. Now, you normally should trade at a specific time of the day every day, because these algorithms, they repeat the same things over and over again. It's like a rinse and repeat process. Now, if we look on the 1 hourly time frame, we can see that our price is coming down nicely. Now, I've already entered a trade to the upside when I saw the market come down to these levels, right? And as we had this nice correction here, you can see it on the 1 minute. So the market was coming down and it had a push to the upside and a nice corrective structure. I was expecting this to be a bounce, at least give me a nice retracement up to these levels here, where I stand to make a profit of about $205. And if we are to measure that in pips, that would be exactly 100 pips. I normally take very short trades, 50 pips, 100 pips, then I'm out of the market. That is my daily profit target. Okay, so if I can get this trade, I'll be very happy. And then if it makes a nice retracement and comes back down, I'm obviously going to be ready for that move, because we can clearly see on the larger time frame that our market is obviously on the downside, most probably going to break out of this range and continue expanding the range to the downside. Okay. Now, on this trade that I'm already in, if the market just decides to go down from here, I have my stop loss at minus $121, and then it's just going to be a tough luck for me. Okay, so the important concepts, or just to summarize and sum up this video, you want to use the Elliott wave theory to get the overall sentiment of the market. And then you use your extreme prices for Monday and Tuesday to determine the overall weekly highs and lows for that particular week. And then you want to use Thursday, Friday, and Saturday just to be playing within that range, and possibly look out for breakout trades, fake breakouts, and reversal trades. I hope you guys benefited from watching this video. Until the next video, trade responsibly. Cheers and bye-bye.